the banks are in trouble. And not only that, no one wants to leave their money in the bank. They'd rather move it to treasuries, which short-term treasuries with disintermediating the bank, or even into money markets away from the regional banks and into the bigger banks. The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash, and cash quick, and they're in trouble. It's kind of like, you're pawning off your wedding ring at this point, and hopefully you'll lend it to the pawn shop. Hopefully you'll buy it back because your other assets are already gone. And it's a very scary sign, to be honest with you.
In today's news headlines, precious metals on a wild ride, gold and silver markets grapple with unprecedented volatility. The global financial landscape is currently gripped by an extraordinary phenomenon in the precious metals sector as gold and silver markets experience a period of unprecedented volatility. Dubbed a wild ride by market analysts, this era is characterized by historic price surges that have seen both metals reach new all-time highs, only to be swiftly followed by sharp and significant declines. This intense fluctuation presents a complex challenge for investors, demanding a reevaluation of traditional strategies and a keen eye on market dynamics as the world navigates a confluence of economic and geopolitical uncertainties. The immediate implications of this extreme volatility are profound, shaking investor confidence while simultaneously presenting unique opportunities for those agile enough to navigate the choppy waters. For individual and institutional investors alike, understanding the drivers behind these dramatic swings is paramount to safeguarding portfolios and capitalizing on emerging trends in a market that seems to redefine its boundaries daily. The past 2 years, particularly 2024 and 2025, have been nothing short of historic for gold and silver. The yellow metals journey included breaking the $3,000 mark by mid-March 2025 and adding another $1,000 in subsequent months. Silver's trajectory has been even more dramatic, exhibiting heightened volatility characteristic of its smaller market size and dual role as both a precious and industrial metal. It reached an all-time high of $54.3775 per ounce around mid-October 2025, shattering its previous record set in 1980. Silver's rally has been astounding, surging nearly 87% since the beginning of 2025 and boasting a year-to-date gain exceeding 70%. Yet its susceptibility to sharp declines was starkly evident when it plunged over 7% today, and it's trading below $48.40 per ounce. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Comments in the YouTube sections, they'll say things like, well, they've been saying this for years. That's our curse. We're early and we see things based upon mathematics, logic, and economics. That's Mother Nature in essence. That's the law of mathematics, the law of economics. Some of these things are not really law, but math you can't run from. And these things always manifest themselves somehow, some way, usually way later than we ever think. But these are the things that we have been saying for a long time, and guys like Alistair who have been saying, and the Western elite have had a very, very magnificent ability to keep the ball up in the air through all sorts of gimmicks and tricks, accounting tricks, injections of money, lying about the measurements of inflation and employment, and on and on and on, right? But at some point, Mother Nature says, well, you know what, your time is up. And at one of these moments when we least expect it, you will see a problem with a major bank, the systemic nature of it. We could look at the problems at the LBMA as an example. All we keep doing is focusing on the LBMA and what happens if there is a silver failure to deliver by one of these massive banks. These are all commercial banks. Well, if a bank fails in silver, fails to deliver, the systemic reaction, the contagion, would spiral through everything because they're not just bullion banks. They're banks that have their fingers in all of the other financial pies. The same thing is true here. And that you see one of these banks and you start to see problems with commercial loans. Not only that, you have what's called credit default swaps, where in essence, you're buying insurance against this stuff. And this is why AIG had to get bailed out if it gets bad enough. And you start to see big banks fail because of, bankruptcies, which are non-recourse in commercial real estate. And you just see this cascading effect. Now, we haven't seen it yet, but logic would dictate that we might, right? Who's going back to the office? And it's the opposite of that. Who knows where this leads? And this is when you see people start to pull out of regional banks, and the regional banks are the ones in big trouble, in my opinion, because of this exposure. So, yeah, I think that this is why you see assets like gold and silver and cryptocurrencies like Bitcoin being purchased, because people are trying to get away from the potential for a systemic contagion that's out there. And this is a good example of how it could happen. And if the Fed wasn't concerned about it, well, they'd be a little bit more open about it. The fact that they're so hush-hush reminds me of the FDIC saying, well, if the public really knew, they'd freak out. Remember, we showed that video a year or two ago. It's the same thing, and it's just more of the same thing. That's why people like you, I always say it, are more of a real source of information and news than the media, which is more about divisiveness and entertainment, if you want to call it that. It's not about understanding what's really happening. And John, Rubino, and Alistair, they're spot on. This is a problem that has not yet resolved itself, not even close.
In today's news recap, Bridgewater warns without retail participation, gold prices above $4,000 may face insufficient demand. Hudson Attar, head of currency-like assets at Bridgewater China, noted in an internal interview that the key to the current gold market lies in the sustainability of continued accumulation by high net worth investors in the West. Apparently, Bridgewater is turning less bullish despite increasing their position in gold last quarter. They say that if these investors maintain the significant allocations seen since September, there is still room for gold prices to rise. However, tail risks such as uncontrollable inflation could alter sentiment. Conversely, if market uncertainty decreases, investor demand for allocation may ease, making it difficult for gold to sustain its current highs. Attar estimates that global central bank purchases of gold may support prices within the range of $3,000 to $3,500, but levels above $4,000 would likely see insufficient demand without retail participation. He analyzed that this round of gold price increases has been substantial and rapid, occurring during the off-season for physical demand in Asia, such as China's National Day holiday, suggesting future physical demand might adjust accordingly. Additionally, the rise in gold has exhibited an independent trend showing weak correlation with asset reallocation driven by currency depreciation and decoupling from Bitcoin. The outperformance of gold relative to silver also exceeds the normal beta coefficient, indicating that the growth in demand may not be sustainable. He cautioned that market judgment should remain prudent, as this could also mark the early stages of a larger scale shift in asset allocation. Public records show that Bridgewater Funds significantly increased its holdings in the SPDR Gold ETF in the first quarter of this year, with a position size of $337 million by the end of the second quarter, accounting for 1.36% of its U.S. equity portfolio. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
First of all, there are other grading services. The premier grading services are PCGS and NGC. PCGS, the professional coin grading service, right there. They're part of Collectors Universe, publicly traded company, and and the Numismatic Guarantee Company. And these two companies do nothing but standardize the industry. Now, if we're talking common $20 gold pieces, that should never happen. Never, ever happen. With one caveat. When you get up into higher graded coins, and 64 on the Saint or a Lib really isn't that high at all. But when you get up into higher graded coins or rarer coins based upon age and scarcity and whatnot, PCGS came out with something called CAC grading, which is just a step above. In other words, there are different levels of 64s and whatnot in the respect that, how can I say this? Like eye appeal, right? The coin may classify as a 64, and it is a 64. For the guy to say it's not a 64 if it's PCGS and NGC is absolute crap. However, there is an issue with eye appeal, and one 64 may not look as good as another 64, and that is true. And CAC grading came out, and I don't know what it's NGC Star or NGC Plus, I don't remember, but they're coins that are very clean. So sometimes when a coin is certified, and in this holder here, it's hermetically sealed. But if a little drop of air gets in there when they're sealing it, over time, that air can create a copper spot because they're not pure gold. They were used as legal tender. So there's alloy in them. That little bit of air over time would create spotting. And there might be other examples of a 64 that looks like a 65 or a 66 and one that looks like a 63. In higher graded coins and more expensive coins, that is legit. That's why they had it. And again, it's really a knock against them, I guess you could say, of having to come out with 64 CAC or, PCGS CAC. And I forget what it even stands for, but it basically means it's got great eye appeal. Look, when you're buying, this is the whole thing about buying numismatics. For me, if I'm going to buy numismatic coins, I am going to buy semi-numismatic coins, common stuff up through grade 64, 65, where you don't ever have to worry about that. If you're going to get into numismatics and you're going to start collecting higher price stuff, rarer stuff, you need to immerse yourself in the nuances like this. But I don't know which company it is, but I will tell you this, that if anyone were to send me back 500 MS64s right now, St. Gaudens, they would never, ever hear from me saying, those didn't measure up. That is not true. That is not true. They are standardized. And I guess I'd have to see the story at greater length to have a little bit more of a perspective. But here again, shouldn't happen in general unless it's a really rare or expensive or high grade coin.
And you make a good point that the two grading services that you keep mentioning, PCGS and NGC, are the ones that we are aware are the most well-known, well-followed, well-trusted.
The other ones are fugazi, period. The other ones you don't want anything to do with. I mean, and they're fine. Some of them are okay, but the dealers will not honor them the way they will PCGS. PCGS and NGC are Coca-Cola and Pepsi. Everything else is...
What do you think of Schectman's take? Do you agree that a massive gold and silver squeeze could happen in December? Is he just talking his book? Will gold and silver top very soon? Post in the comment section down below your honest opinion. Hype the video if you liked it. And make sure to watch this one right here because it's a perfect fit for you. And I'll see you on the other side.